Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Where are you based right now? You in Nashville?
Nashville, Tennessee.
That's awesome. Is that town still just booming?
Yeah, there's probably not quite as many cranes in the sky as there was from 2010 to 2020, but still a lot of building going on and a lot of people moving in.
Do you get out to the music scene at all?
I try to, but I'm not a big country music fan, so it's ironic that I live in Nashville.
Well, it's funny. If you ever move away, I think you might find that you end up missing country music, and you might like it. I don't know. I grew up in Texas, and for some reason I hated it every time I heard it, and then I moved away to Chicago, and then when I heard it, it was like nostalgia. I missed it, and now I love it. So.
Well, what is amazing is it doesn't matter where you go. Every musician here is ridiculously talented.
Yeah.
So it almost doesn't matter what the venue is. You're going to hear great music. I've lived in a lot of other cities before this, and that's not always the case.
Yeah. Well, so I'm speaking with Tavis McCourt, institutional equity strategist at Raymond James. And today we're going to talk about the overall markets in the U.S. And one particular area that I was interested in talking about too was small cap stocks and perhaps any opportunities there. And so we'll just keep the conversation going. And Tavis, welcome. Thanks for coming on the podcast.
Great to be here. Thanks for having me.
I was just kind of curious. I was perusing some headlines today and I don't know, get your quick thoughts on it in terms of trying to maybe lay the playing field for our discussion later on too. But something stood out to me, which is there was a report that Apple had gained nearly $1 billion in deposits in 4 days in their high yield savings account. Does that strike you as interesting, or is that perhaps like a new trend to see? Is Apple gaining those kind of deposits?
Not, I mean, at the system-wide level, frankly, deposits have been really stable for the last month. The good news about the banking system is you don't need to rely on Twitter and the media. The Fed literally publishes a full system-wide balance sheet of the banking system every week. Interestingly, small bank deposits have actually gone up in the last month. Large bank deposits have gone down a little bit. So there's a real big disconnect between kind of what's happening in reality so far, at least, versus the media speculation.
We typically try not to date our conversations, but it is kind of an interesting day where it's another Fed decision day. It's May 3rd, May 3rd that we're talking right now. There's a lot of speculation in terms of whether or not they'll stand pat, raise rates again. Irrespective of that, kind of what's your just kind of broad take of where we stand right now in the U.S. markets and the U.S. economy?
Yeah, I think we're solely in kind of a very late part of the economic cycle. The Fed has kind of accelerated it, and the bank crisis, or whatever we're going to ultimately call March, whether it was a crisis or not, accelerated this late cycle phenomena. So ultimately what that means is the Fed's probably just about done hiking. That could be today, could be a month from now. Nominal consumer spending is slowing pretty dramatically. It will continue to slow pretty dramatically as the year progresses. The good news for that is inflation will get better and better as that spending slows. The bad news is earnings will likely continue to come down. And so it's a really muddled message for the equity market. My best guess is we've been in this kind of S&P 500 range of 3,600 to 4,300 for a year. We may be in it for another 9 months at least, maybe a little longer, as we kind of digest all that's going on right now.
What's driving your take on consumer spending? I mean, I guess you're seeing spending actually come down, but we've been spending more than we are taking in. Is that right?
Yeah, and I think the Fed doesn't acknowledge this, but I hope they realize it kind of behind closed doors. We are spending and we are undergoing economic activity right now in the country well beyond what we're capable of maintaining. So it's not as if the economic activity is false. It exists. It's real. The spending is real. It's just not sustainable. Essentially, people have been pulling money out of the bank, thus the banking problem, and spending that money in the goods and services economy. And that excess spending, which has been bouncing around between $500 billion and $1 trillion a year of excess spending for the last year, has been putting a lot of pressure on inflation and the labor market. That pressure will start to go away as the spending comes down. And it's really as simple as at what point in time are consumers going to be going to finally be unwilling to watch their checking and savings account balances go down. They're not going to watch those go down forever. When they will adjust their spending so that they can start saving again, and they really haven't saved on an aggregate basis in well over a year. And so I think we're kind of really near this tipping point where savings rates will move back up to normal, money supply will start growing again, and as that happens, the flip side of that coin is consumer spending will come down pretty significantly from kind of 6% in March. My guess would be kind of 2 to 4% by the end of the year.
How does the jobs picture play into that, and or salaries? Are salaries going up as well?
They are, but they're decelerating. So average wage growth across the U.S. peaked out at about 6.5% in 21. And even though the labor market theoretically has been getting tighter for the last year and a half, average wages have actually come down close to 4%. It's still a little bit above normal, but it's really interesting when you look back at the data. Essentially, what's going on is I think economists got fooled into thinking that we had this massive wage increase across the economy, and really what was going on more than that was just a mix shift of labor from service jobs to goods jobs. So kind of simplistically putting it, people leaving restaurants at $15 an hour and going to Amazon warehouses at $30 an hour. And when you aggregate that across an entire economy, it leads to the average wage increasing. And so as Amazon has laid off workers and restaurants have picked back up workers because consumer demand has moved back more to services, labor has moved into more of the lower wage jobs as well. And what we're finding is on a like-for-like basis, there really wasn't the type of wage inflation that looked like in 2021.
And do I don't know, when I look at the headlines and I think about when I see calls for strikes and labor unrest, I don't know, does that play into it at all? Maybe that's not enough to drive labor prices up.
Yeah, it certainly plays into it in Europe. So everything I just said does not apply to Europe at all. And Europe is in a much more similar position to the U.S. in the 1970s. It is much more union dominated. And even without unions, just culturally, people tend to get wage increases in line with inflation, even if they're not a part of a union. There are areas of tightness in the labor market. Blue collar labor is very tight. Frankly, it was very tight before the pandemic. It's going to be very tight 10 years from now. It's going to keep on being tight until we tell kids it's okay, you don't have to go to college. We have an excess of white collar labor in the U.S. And that is 2/3 to 3/4 of the labor force. And as long as we have that excess, the wage pressure on that very significant part of the labor force is going to keep us from having material wage inflation.
That's interesting. You think so? Our economy is just matured to that point where it's gone from a blue collar labor to more service labor, and now we've kind of peaked on the service side.
I think there's still a lot more demand for services labor, but the supply is increasing faster. So I mean, the demand for blue collar labor actually doesn't grow that fast, but it still exists. We just can't have everybody going to college and wearing a white collar shirt. At some point, somebody needs to do the construction and truck driving and all this, and so there's a lot of areas, especially skilled blue collar labor, is really in short supply, and that's not going to change. It may loosen up a little bit if we have a recession, but that will be an issue for the rest of our investing lives, I suspect.
Yeah, and I guess with I don't know if you buy into also some of the headlines too, where with the increasing price of tuition in college, people are really questioning the value of college, and would you envision seeing an increase in apprenticeship for certain jobs?
Yeah, I mean, I think capitalism works, right? Like as white collar wages come down relative to blue collar wages, more people will choose blue collar jobs. I don't know that we've seen any evidence of that happening yet. I think the one of the unfortunate outcomes of the pandemic from a labor market perspective is that people were already disproportionately choosing a white collar career beforehand. And during the pandemic, essentially what happened was like your average white collar worker was working from home, day drinking, right? Your average blue collar worker was working their butts off. And so it just made it even less likely that somebody would choose that blue collar work. So yeah, I mean, the free markets will solve this, and they'll solve it by raising wages in the blue collar work and lowering wages and making it more painful to do white collar work.
Consumer spending, the unsustainable consumer spending that we have right now. What do you look for to kind of indicate there's breakage, or like, okay, now it's breaking. Now, what's the breaking point there?
Yeah, I don't know if there's a breaking point or if it just kind of decelerates. Consumer spending is big, right? 70% of the economy. And historically, even in the financial crisis, it didn't go from like plus 5% to minus 5% in 3 months. It just decelerated, over the course of a year or two. I suspect that'll be the case this time too. So savings rates will come back to something closer to normal. And at the same time, we're getting rid of a lot of COVID benefits in the economy. So food stamp benefits went away in early March. Medicaid benefits start going away in May. And then allegedly student loans are going to have to be repaid again starting in the third quarter. So it's just, those are headwinds. I haven't even talked about rates, right? Like this was going to happen even if the Fed hadn't done anything. On top of this, the Fed, I don't know if you've noticed, but they've raised rates. So like the average car loan is $750 a month. Okay, I don't think there's going to be a lot of cars being sold. So there's a lot of headwinds to the consumer economy.
Yeah, I guess as they start to see their savings kind of disappear, and they'll start to slow down, start to want to increase that again, and so that will take some inflation pressure off. Is kind of your premise also?
Oh yeah, for
so
sure.
You see inflation decelerating even further.
Yeah, and it's really just decelerated much faster than is evident in the numbers because the Fed uses estimates of shelter inflation that are really backwards looking. So they calculate shelter inflation in a cutting edge 1955 kind of way. They send out surveys to part of the country once a month. So it takes them several months to get a full view of the country. And that survey is not asking what are the rental prices for new leases today. It's asking what are your rental prices today. And so it's not forward looking at all. Forward looking rental prices are already peaked out in March of last year and up 11% year over year, and are down to about 2% year over year. Again, not because the Fed's done anything, simply because capitalism works. We're building a ton of supply of apartments, and as those new apartments hit the market, supply is exceeding demand all of a sudden. And so what used to be a big price increase is now a significant deceleration. Ultimately, I think prices there will come down to negative territory for several months. And so the Fed data is just 12 months to 15 months lagged. So it's just the shelter inflation is just starting to crest. And so essentially what it suggests is as we get into like second half of 24, we're going to have a really, really low core CPI because their shelter inflation is it's going to start seeing the impact of what we're seeing in the real world today. Outside of shelter, basically inflation is down to 3% or so year over year. So not back to 2%, but it's getting there, making progress. And again, we haven't lost a job yet.
Well, hopefully next year I can negotiate my rent lower
instead
of up.
Well, if you're in New York, like everything I just said does not hold for New York or California.
Oh, darn
Completely
it.
corrupt states where it's essentially illegal to build new supply. So if you don't let the free market work, the free market's not gonna have a solution. In New York and California, the free market doesn't really work. But apartment prices are plummeting across the Southeast and where a lot of people are moving.
Yeah. Yeah, I know some parts of the South, there's been tons of building. There's a lot of new apartments coming on board. It'll be interesting to see how all that plays out.
Yeah.
I think in one of your latest research reports, you likened inflation or the current environment, you characterize it more akin to the 40s than the 70s. And I wonder if you can explain that.
Yeah, this could be a podcast into itself, but I think the Fed has really done an injustice comparing the inflation today to the 1970s. The economic data today bears very little resemblance to the 1970s. In the 1970s, we had job growth for the inflationary period, so like 68 through 85. Job growth annually across 18 years was almost 3% a year. We just had 3% 1 year last year. There's no way we're going to hit 3% this year. So there's a lot more there. And so the reason was, so demographically, you had the biggest generation on a relative basis ever to come of age, start coming of age and getting jobs. Simultaneously, women are going to work at much greater rates in the 1970s. And so you had all this job growth. On top of that, you had tremendous wage growth. So across 18 years, average hourly wages were up about 6.5% on average over 18 years, even in years where unemployment rate was up 10%. And so all this is driving significant consumer demand because more people have jobs and they're getting bigger wages in those jobs. So So nominal income, disposable income over 18 years, averaged 9% a year. Well, you're not going to stop inflation when you have disposable income growing 9% a year. It's just too much money coming into the economy of goods and services. That's not happening today. Income growth since 2019 has been running 4 or 5%. Wage growth is 4% and decelerating. Job growth was good last year, but we're kind of at a peak. Like there's no way that can continue. What's happening is before March, we had been able to get 8 or 9% nominal consumer spending, just like the 70s, not because incomes were growing 9% like they were in the 70s, but because people were pulling money out of the bank to spend in the real economy. And it's not sustainable. If you look across history, like when that did happen, it was the 1940s after the war. So because the U.S. didn't really lose any fixed assets during the war, economically, the pandemic looked incredibly similar to World War II. Savings rates spiked higher. So in World War II, everybody had a job, wages were incredibly high, but you weren't allowed to spend on anything because the government was trying to force savings to finance the war. Very, very similar to the pandemic. Everybody had incomes were very high, but you weren't allowed to spend on anything because the government locked you in your house. So the outcome was you had significant excess savings in the system. So in 2021, there was about $24,000 per household in excess savings. In other words, cash that they had at the end of 21 that they would not have had the pandemic never happened. In 1946, that number was $60,000 in today's terms. So the average household had a lot more cash. So not surprisingly, when the government reopened the economy on July 1st, 1946, guess what happened? That cash came pouring back into the real economy for goods and services. At the time, what did everybody want? They wanted a car because you were not able to buy a car from 1942 to 1945. In the same way that you weren't able to go to a restaurant from 2020 and early 21. And so the car companies did not have the supply to meet that demand because they had to retool from making tanks to making cars. So we have massive inflation in 46 and 47, 48. Fed didn't raise rates at all. And lo and behold, inflation resolved itself and we actually had deflation in 49 and 50 because free market works, capitalism works. We just built supply. And as supply came, what happened in 1948 and 49 is supply came up. GM went from making 3 million cars to 9 million cars to meet this level of demand that was so incredibly high. What they found out, just like a lot of companies are finding out today, that level of demand was not sustainable. All of a sudden it went down because part of that demand was just pulling out of bank accounts to spend in the real economy. It wasn't wage growth. And so all of a sudden you go from this demand exceeding supply to very rapidly supply exceeding demand. And that's exactly what we're seeing today. We saw it last year in semiconductor companies and FedEx and Amazon. The most sophisticated companies in the world have been absolutely blown away by how fast this environment of demand exceeding supply has transitioned into supply exceeding demand. And they've got great real-time information. What chances does the Fed have, looking at cutting-edge 1955 data collection methodologies, of catching this transition? Effectively zero. They're going to be completely whipsawed, like all these companies have, about how quickly this economy shifts from demand exceeding supply to supply exceeding demand. And I think we're near that point.
Yeah. And does that presuppose that there will be a recession, even if just a shallow one, that we have to go through that?
I don't know if you have to. The good news is we're starting all this from a very high level, but things need to slow. Things have been slowing. So just, as a nominal GDP has been slowing every single quarter for 6 quarters now. And at some point, if it keeps on slowing, real GDP will go negative. Labor market's tight. So, it seems, I think most economists that are predicting a mild recession seems right to me. Be hard to have a deep recession unless the labor market, we start having 8 or 9% unemployment, which anything's possible, but it seems less likely at this point, given how tight the labor market is.
Yeah, that's good advice. So your work, you typically focus on doing research for an institutional audience, right? So I think which I think is great. And I'm really happy to have you on the podcast because I like that perspective too, even for financial advisors or individual investors. Just kind of curious, what are you seeing from that cohort of investors in terms of how they're positioning their portfolio or flows into different areas of the U.S. equity market?
Yeah, so when I talk about institutions to the retail side of the business, there's a couple of things that I think retail needs to understand. Institutions always have to be fully invested. So they almost don't care at all what the equity market is doing. They care a lot more about what is outperforming or underperforming on a relative basis within the equity market. What I would say and why this market seems so resilient this year is that the institutional market got about as bearish as it can legally become in Q2 of last year. So Russia invades Ukraine. Most hedge funds had kind of delevered their positions already because of Powell's hawkish commentary. And then they just got downright apocalyptic in Q2. So, every equity market was down 20-25% in Q2. And like, not only were we not in a recession yet, we hadn't even really started to slow yet. Like everything I said about like things are slowing, like that's all happened since Q2. We haven't seen that before. Retail flows, at least internally, had remained really good up until October. So it's this very strange dynamic where institutions were not just like marginally more bearish, but literally as bearish as February of 2009. At the same time, retail was just kind of like putting more money in the market every month. And what's happened in the last 6 months is almost the exact reverse. So institutions are a lot less bearish today. I wouldn't say they're bullish, but they're a lot less bearish because we're kind of nearing the end of the Fed rate hiking cycle. Hedge funds especially pay more attention to kind of liquidity than they do kind of fundamental earnings. And so the Fed rate hiking cycle is really important. Retail has gotten really bearish all of a sudden. I think that's why we're seeing the market hold up, even though all the economic data looks pretty bad. We're used to everything happening at the same time, and nothing's happening at the same time, either in the economy or in the markets right now. I think it argues for a lot of chop in this market. In 2008, institutions and retail all got bearish on the market at the same time. They all got bullish on the market at the same time. And that's how you get those big downs and big ups. Right now, we're seeing like just two sides to the coin right now. Over the last year, months where institutions have been very bearish have been months where retail has been pretty bullish and vice versa.
Is there something to take away for retail investors by looking at the institutional flow to kind of rethink about their own positioning? Maybe I should look at the smart money.
I think the only thing to take away, I think a lot of retail investors, I have digested this already, but I would say like every institutional investor plays a very simple game. You're trying to sell to get as defensively positioned. So if you're a mutual fund, that means getting to 5% cash and getting positioned in utilities and staples and really defensive companies about 6 months before a recession. And when a recession hits and retail panics, that's when you get in, you go all in on cyclicals. And that's when you go to 0% cash. I think after watching this happen, retail's getting smart. What happened, and I don't know how this is all going to play out, but what happened in 2018 was pretty interesting. Like the institutional market got incredibly bearish as 2018 went along because they were convinced the Fed was making a mistake. Retail equity flows stayed reasonably positive the whole time. And so what happened was the Fed pivoted and institutions had to rush back into the market, and we had 2019. It's crazy up year, everything not nailed down was up 25%. I don't know. I think like the game that institutions play with the equity markets is buy stocks in a recession, and basically all the money's made within the first year or two of recovery after a recession, which is historically accurate, by the way. I think retail's getting smarter, and but I would say that's the biggest thing to take away. Just realize the time to buy stocks with both hands historically has been like as the recession is starting.
One of the other things that it's kind of come up over the last year or so is the idea of small caps coming back. Maybe we're returning to normal in terms of interest rates and all of that. I don't know, maybe you can kind of level set. How do you look at the various sleeves of the equity markets, large, mid, small, in terms of valuation? Where are the opportunities there?
Well, the valuation's interesting. If you look at the S&P 500, it's trading 18, 19 times earnings, and that's kind of the 80th percentile or so of where the S&P 500 is traded over time. In and of itself, that doesn't make a lot of sense if we're heading into a recession. And so that's why you hear, I think, a lot of folks in the media just saying, look, the equity market's expensive. Well, essentially all of that is 7 tech stocks. If you back out 7 tech stocks, S&P 500 is more like 14, 15 times earnings, which it's not back up the truck cheap, but it's kind of what you would expect if we're going into a mild recession. And I think small and mid caps are more representative of investor psychology, just how bearish the institutional market has been. The small and mid cap equities are trading at price to earnings multiples, not just like below normal, but literally like March or April of 2009, like about as cheap as they've been in the last 25 years. Those earnings probably have to come down, so they're probably not quite as cheap as they appear, but it's a very different story than what the S&P 500 is telling you from a valuation standpoint. There's two questions that come back. Is like, does that mean they're going to normalize at some point? And number two, what's causing this disconnect? I think what's causing this disconnect is primarily global portfolio managers that have been scared to death to put any incremental investments into Europe, Asia, emerging markets since 2018. So the P/E ratio of small, mid-cap, and large-cap indexes were roughly the same throughout time. The only time large caps got a big premium was during the equity bubble in the late 90s for about a year or two. And then suddenly in 2018, this really substantial premium for large cap equities started to exhibit itself. My assumption is global portfolio managers, when they saw that America was kind of entering a trade war period with China, we in America got a little scared. But put yourself in the position of a global manager. Like, how can you invest in stocks in Taiwan, Korea, Singapore, if your major export partner, China, is going to be slowing? Well, the answer is you can't. So they started moving money to the U.S. So if they're all managing to benchmark an MSCI benchmark that's kind of 65% U.S. anyway, they all moved over to 75% U.S. And then COVID just made that worse because we provided a lot more support for our economy than most other countries, and the Russian war made that worse. And so what you had is just, I think, international investors significantly overweight into U.S. Well, when international investors invest in the U.S., they don't invest broadly across the U.S. They invest in the S&P 500, and largely it's a very small subset of the S&P 500 of very high market cap names. So I think the answer to like, when is the S&P 500 going to see its PE come down from 19 times something to more typical 15 or 16 times? Well, one, it's when the growth of these big tech companies slows down, and that may already be happening, we'll see. But two, it's when things could look more investable in Europe and Asia. I think that's going to happen at some point when peace and prosperity breaks out around the world. This doesn't appear like it's the year it's going to happen. So I don't think this, I think there will be a time period. If I was investing over 5 or 10 years, I think small and mid cap has a substantially better risk reward than large cap. But which year that starts is really hard to know. And typically, late in an economic cycle like we are right now is not a time where small and mid caps generally do better. So I think until the recession hits, once it hits, then you'll probably start seeing small and mid caps do better again.
That's interesting. That's really I really like that narrative in terms of the international investors or global investors investing in the U.S. waiting for other international markets perhaps to pick up. I hadn't thought about that before, and I think it's really fascinating. In terms of valuation of the different segments, I think you also mentioned maybe PE is not necessarily the best ratio to just evaluate everything, or perhaps small cap stocks. Is there a better, more relevant ratio for mid and small stocks?
I think it really depends on kind of the sector and the growth profile. Our software analysts focus a lot on enterprise value to gross profit, and that's because all small cap software companies are basically built to be sold, and whoever sells them is going to basically fire everybody in SG&A. So you're basically just buying a gross profit stream. The name of the game is just keep on growing until you get sold. So pricing it on a enterprise value to gross profit makes sense. I think in small cap, you definitely, in a sense, in small cap, you're competing with private venture capital. So you're using a lot of more of the methodology that venture capitalists use to value companies. And those tend to be kind of less price to earnings or price to free cash flow based.
So one of the questions I like to ask our guests as we start to wrap up and come towards the close is give you an opportunity to talk about whatever's kind of top of mind for you in terms of trends. It could be everything we talked about or something totally different, but just kind of curious, what do you see as one long-term trend playing out over the next 1 to 5 years?
Well, the one that pops out is AI, because everybody's talking about it. I think the caution for investors would be, it's so new, it's really hard to know who the ultimate winners are going to be. We're probably, if you were to put an analogy on it, we're kind of like 1995, 1996 with the internet. Well, there were some big winners in 95 or 96, but like the ultimate winners of the internet, Amazon, Apple, Google, it wasn't clear probably till like 08 or 09 for most of those companies. It takes a long time for the market to figure out, who's got the right technology and who's got the right way to commercialize that technology where they can make a profit. There's going to be a lot of losers from AI. We saw it with Chegg this week, which is just the first company to mention risk from AI. So it's not all roses for investors. And I think I was a tech analyst for 20 years. And so what I always kind of remind investors are, tech hasn't created a lot of value because they've innovated. There's been a lot of innovation always in the U.S. economy. Tech has created a lot of value because they've innovated in ways that created natural monopolies. The computing operating system is a natural monopoly. You and I are not going to learn 5 different operating systems for a smartphone or a PC. Like, I know Excel, I have zero ambition to learn a different, Excel spreadsheet. So if Microsoft wants to raise price, guess what? I'm probably paying. And so search engines were natural monopolies. Like, it just did not make any sense to have more than one search engine in the world. So that's what made tech in the last 20 years really, really special. There's tons of innovation in clean tech, but none of it is a natural monopoly. So these stocks are just like up and down and very little kind of huge winners in clean tech. That's the unknown with AI. Like, it's clearly going to be much more important to the economy in the future, but does it allow companies to create natural monopoly positions and these incredible returns on capital that were exhibited at Google and Microsoft and Apple and Amazon for the last couple of decades? I don't know about that. So it's certainly very interesting. No, I think it's everybody in the tech industry has been kind of blown away at the sudden accuracy of these large language models.
Yeah, totally. It's been pretty phenomenal and interesting. And all over the headlines. That's one of the reasons why it was going to be one of my trend or fad questions for you. It sounds like if you were to answer that now, it'd be a trend, but it's still to play out, right?
Yeah, the trend, but it'll take a while to play out.
Yeah, I guess from my perspective, I definitely agree with that, but also I am a little wary of. I think it can be used in a very faddish way right now, particularly by product sponsors. With other funds and, invest in AI. It's so hard to identify, as you said, the winners in AI right now.
We might not even know they exist. So everybody's buying the big tech stocks, like they're going to be the winners, like they might be. But like last I heard, we're all using a product from a company that was started in 2015, OpenAI.
Yeah.
So it's I think as an investor, it's fun to trade these things. I mean, you can always trade them, but like, it's really hard to know the winners this early in any kind of new product.
Yeah, definitely. I guess the only thing I would consider is perhaps, invest in the things that help them run or make them run, the brains, like the semiconductors or something.
Yeah, and that's where, NVIDIA clearly seems to have a very big lead, really leading machine learning and artificial intelligence for a couple of decades now in colleges. And so, it's unclear who will catch up or if they'll catch up, but yeah, I agree. There'll be a lot of chips sold over the next couple of years related to AI.
Great. Let's do trend or fad or speed round. So given your background as a tech analyst, I'm kind of curious about this one. Cryptocurrencies, trend or fad?
Fad.
T-bills, trend or fad?
Depends on your time frame. This year, a trend, but over the next 3 years, a fad.
Wellness companies, trend or fad?
Trend.
Ice baths, trend or fad?
Trend.
And buy now, pay later, trend or fad?
Fad.
All right. Awesome. Easy enough, right? Tavis, thank you so much for being on the podcast with me. What's the best way for people to follow you and learn more about what you're doing?
Through their Raymond James representative. So I publish notes and all are available to Raymond James Private Client Group.
Fantastic. Well, again, thank you for sharing some of your insights with us today, and look forward to talking to you again soon.
Great. Thanks a lot. Great to be here.
And thank you for tuning in to another episode of Trends with Benefits.